Welcome to the Crosswind Approach podcast. I'm your host, Michael Baldree, CPA. This podcast is for nonprofit and mission-driven leaders who desire to lead with confidence while navigating uncertain conditions. On each episode of the Crosswind Approach, we'll have a conversation with a leader who has traversed real turbulence while leading their organization. Together, we explore the habits that help organizations become resilient and remain mission-focused. If you're leading a mission-driven organization and looking to navigate toward greater clarity and confidence, you're in the right place. So sit back, relax, and enjoy this episode of the Crosswind Approach. Welcome aboard. Welcome to the Crosswind Approach. I'm your host, Michael Baldree. And on this episode, I want to discuss what a fractional CFO for nonprofit organizations is not. Because in my experience, most nonprofit leaders misunderstand the concept of a fractional CFO, not necessarily because they have bad information, but more often because the information they have been given is incomplete. And information that is incomplete in a financial leadership context is not good because it can send your organization way off course in ways you cannot see until it's too late. Which brings me to an aviation story that illustrates this point. On the Crosswind Approach, we always begin with a fascinating aviation story and apply lessons learned from the story to nonprofit leadership. So let's dive right into this story. It's New Year's Day, 1985, an Eastern Airlines Flight 980, a Boeing 727 carrying 29 passengers, departs from Paraguay bound for Miami with a stopover in La Paz, Bolivia. The approach into La Paz Airport is one of the most dangerous in commercial aviation. Why? Well, the airport sits at about 14,000 feet, and the Andes Mountains rise to 21,000 feet on either side of the airport. I actually lived in La Paz, Bolivia from 1989 to 1993, flew into the airport many times. It is a dangerous landing for sure. On that New Year's Day for Eastern Flight 980 at 7:30 p.m., the captain radioed approach control in La Paz, and the tower cleared Eastern Flight 980 to descend from 25,000 to 18,000 feet. And that was the last time anyone heard from Eastern Flight 980. After that radio communication, the aircraft likely drifted off course to avoid a storm. But the navigation system could not tell the crew how far off track they had gone. The primary system had a known flaw that pulled the aircraft towards Mount Illimani, which is a 21,000-foot mountain, a wall of rock and ice, and the plane had no ground proximity warning system to alert the crew that terrain was closing in. Eastern Flight 980 flew into the south face of Mount Illimani at 19,600 feet, and all 29 passengers on board perished. The investigation called it a controlled flight into terrain, which means the aircraft was mechanically sound. The engines were running, controls were working, nothing was broken. The crew simply did not know where they were. They were flying with confidence in a direction that was fatally wrong, and they did not have the instruments to tell them otherwise. Flying with confidence in a direction that is fatally wrong. That sentence describes many nonprofit organizations that I speak with. I talk to executive directors and CEOs every month who are smart, mission-driven, hardworking leaders, and they are struggling financially not because they lack passion or commitment. They are struggling financially because they're flying without the right instruments. They have a bookkeeper. They might have an accountant, maybe a board treasurer who reviews a set of financials once a quarter, and they believe that is enough. That is their navigation system. And just like the navigation system on Eastern Flight 980, it might look like it's working, but it has a built-in drift that is quietly pulling them towards a mountain they cannot see. And that's what this episode is about. I want to talk about what a fractional CFO for nonprofit organizations actually is, how it helps, but I'm going to do it by first telling you what a fractional CFO is not, because the misconceptions are where the danger lives. So, number one, what a fractional CFO is not. A fractional CFO is not your bookkeeper. A bookkeeper looks backward. A fractional CFO looks forward. And this is a common misconception that I encounter. Your bookkeeper is absolutely critical. They record historical transactions that are the backbone of your financial system. And it's essential, but it is historical, the work they do. It tells you what already happened. And in fact, most nonprofit leaders, the only information they're getting is backward-looking information, your statement of activities, your budget to actual, your bank reconciliation. And if that's all the information you're getting, it's like driving a car by only looking in the rear view mirror. A fractional CFO takes that critical, important historical information and then uses it to forward project. A fractional CFO looks forward and they ask important questions such as, what does our cash position look like 6 months from now? If we wanted to launch that new program in the fall, what does the financial runway need to look like? If a major grant ends in 12 months from now, what is the plan to replace that revenue? And when do we need to start executing? These are the forward-looking questions that a fractional CFO can help your team with. If you were to survey nonprofit leaders, more than half would likely identify financial health as their single biggest concern, and most specifically, they would identify revenue and cash flow issues as what keeps them up at night. What that means is that nonprofit leaders are dealing with real problems that are unfolding before their eyes, but they don't have the forward-looking tools to get ahead of those problems. And that is exactly the gap a fractional CFO fills. So number one, a fractional CFO is not a bookkeeper. Number two, a fractional CFO is not a full-time executive you cannot afford. When I say the words chief financial officer, many nonprofit leaders immediately get scared. They think six-figure salary, benefits, and a line item their budget cannot absorb. But that is not what fractional CFO means. A fractional CFO means you get a senior level financial expert who's embedded in your team on a flexible part-time basis, scoped to your organization's specific priorities. You are paying for the strategic hours that move the needle forward. Budget development, cash flow forecasting, board reporting, grant compliance, and scenario modeling. And it scales. During audit season or major grant cycle, involvement increases. When things stabilize, it scales back. Your organization gets what it needs when it needs it without a fixed cost you cannot sustain. So what is a fractional CFO? Number one, we said it's not a bookkeeper. We don't look just backwards, we look forwards. Number two, it's not a service that only certain nonprofits can afford. Number three, a fractional CFO does not replace your leadership. Number three, a fractional CFO does not replace your leadership. What do I mean by this? Well, many executive directors and CEO believe that a fractional CFO is going to come in and make all the decisions for them. That's wrong. What a fractional CFO is going to do is give you the information, the data to help your team make better decisions. I meet executive directors all the time who are brilliant at fundraising, program designs, and community building, but they're spending 20, 30, maybe more % of their time wrestling with financial analysis. That is not their core strength. And every hour they spend building a cash flow projection or an hour doing budget variance analysis is an hour they're not spending on donor meetings that could bring in the revenue that more than pays for a fractional CFO's time. A fractional CFO does not replace you. A fractional CFO frees you and your team to do the work only you can do. Number 4, what a fractional CFO is not. A fractional CFO is not only for large nonprofits. There is a myth that CFO level financial leadership is only for organizations with budgets over a certain threshold. And I would argue the opposite. Smaller organizations need strategic financial oversight just as much, if not more, because they have less margin for error. For example, if you're a nonprofit with a $2 million budget and you lose a $400,000 grant because your financial documentation did not meet the funded standards, that is 20% of your revenue gone. Not because your mission was weak, because your financial infrastructure could not tell the story the funder needed to hear. A fractional CFO builds the infrastructure that makes your organization fundable at higher levels. So now that we've cleared 4 common misconceptions of what a fractional CFO is not, let's then talk about what a fractional CFO actually is. And let me give you the clearest definition that I can. I want you to think of it this way. Your bookkeeper and your accountant, they really are the scoreboard. They tell you what the score is. All that historical information that they look at on a daily basis. But a scoreboard has never won a game for an organization. A fractional CFO is the coach who looks at that scoreboard, all that historical information, and reads what is happening on the field now. And then, based on that information, builds the game plan for the second half that gives your team the best chance to win. They take the numbers your accounting team produces and turns those numbers into strategy, direction, and decisions that move your mission forward. They help you focus on the strategic plan. And here's something most nonprofit leaders do not expect. A good fractional CFO does not just stay in the accounting lane. They help integrate the development and fundraising side into the financial strategy. They analyze your revenue streams and identify dangerous concentrations. If 45% of your funding comes from one government grant, they're going to flag that. And a fractional CFO is going to help you build a diversification plan. A fractional CFO works alongside your development team to model new revenue sources. And they're going to help you plan and establish a legacy giving program as part of a long-term strategic financial plan. Because an organization that is only funding this year's operations is not building for the future. And I really think that matters now more than ever. For example, the Association of Fundraising Professionals, their latest data shows that total giving for nonprofits grew about 5% in 2025. But the number of donors declined nearly 4%, continuing a 5-year downward trend. What does that mean? Well, that means that your organization is likely becoming more and more dependent on fewer, larger donors, and that is a concentration risk. And a fractional CFO, a good one, is going to recognize that pattern in the data and helps you build a strategy to address it before it becomes a vulnerability. And a fractional CFO does all this without requiring you to commit to a full-time salary your budget cannot support. Here's another thing a good fractional CFO does accomplish. A fractional CFO helps to transform your board meetings. Your board needs financial reporting that is tailored to helping them make better strategic decisions. I need to repeat that because most boards are not getting this. Your boards need financial reporting that is tailored to helping them make better strategic decisions. Here's a question I ask every nonprofit board I work with. After reviewing last month's financial report, how many of you felt fully confident in your understanding of the organization's financial health? The silence that follows tells me everything I need to know. Most nonprofit board financial reports are dense spreadsheets that assume every board member thinks like an accountant. They do not, nor should they think like an accountant. When board members do not understand the financial picture, what happens is they disengage entirely, or they get lost debating line items instead of focusing on strategy. And neither of those serve your mission. A good fractional CFO builds visual dashboards that show days of cash on hand, restricted versus unrestricted net assets, budget variance at a glance, revenue concentration risk, and key performance indicators, KPIs, tied directly to your strategic plan and your mission outcomes. And when a board can see that type of strategy clearly, what happens is they see the financial story clearly, and they understand their role in helping drive better stewardship and better mission outcomes. Their role is to focus not on the accounting spreadsheet detail, but instead to be at 10,000 feet with you, looking at the strategy and making decisions today that will help the organization grow and be more sustainable. And that type of shift in board engagement, that shift alone is worth the investment in a good fractional CFO. So you might be thinking, Michael, how do I choose a good fractional CFO? That's a great question, because what you need to realize is not everyone advertising fractional CFO services is delivering good quality CFO level work. Some are delivering bookkeeping. Some are delivering controller level services under a CFO label. And if you're going to invest in this for your organization, you need to know the difference. Here's what I would tell you to look for. First, you're a nonprofit organization, so look for nonprofit specific experience. Someone who understands restricted versus unrestricted funds, grant compliance, the nuances of Form 990, how to be a liaison between your organization and the organization who is auditing your nonprofit. Second, someone who can speak to your board and your funders in a visual way and in using plain language. If they cannot translate the numbers into plain language, they are a technician and not a good fractional CFO. Third, ask them what their first 90 days of working with you would look like. And pay attention to what they say, because if they talk simply about systems and software more than they talk about the importance of listening and learning and understanding your organization and building relationships that will turn into trust, that should be a cautionary flag to you. I built a 7-step framework that I follow in the first 90 days with every nonprofit client. So my first 90 days, I use this framework with every nonprofit organization I work with. And it starts where most fractional CFOs get it wrong. It does not start with spreadsheets. It does not start with new software. Where does it start? It starts with listening. 30 days of conversations with the CEO, the board, those working the programs, the development team, the finance team, I want to get to know them. I want to understand what their objectives are. I want to understand the strategic plan. And I want to understand all this before I change a single thing. Sometimes it doesn't take 30 days, but it takes a significant amount of time to listen, because I've learned that no lasting financial transformation happens outside of relationship. I want to repeat that. I have learned that no lasting financial transformation happens outside of a relationship built on trust. And once that trust is established, from there, I can assess the financial health of the organization. I can strengthen the internal controls. I can build the cash flow forecast. I can recalibrate the budget to reality, build financial dashboards and KPIs for the board, and develop a long-term strategic financial plan. But I'm not going to do any of that until I listen and build trust. That relation piece and that trust piece is absolutely foundation. I published the full framework in a free guide called the First 90 Days Framework. It walks you through every step in detail, and you can download it at crosswindcfo.com, crosswindcfo.com, or reach out to me directly on LinkedIn, and I will send it to you. Ladies and gentlemen, we are approaching our final descent, but before we reach our final destination, let me share the Crosswind checklist. The Crosswind checklist for nonprofit financial health this week. I want to give you 3 warning signs that your nonprofit may be flying without the right financial instruments. 3 warnings. Number 1, you cannot tell me your cash position 90 days from now. You cannot tell me your cash position 90 days from now. That's a warning sign you need to pay attention to. If you do not have a forward-looking cash flow forecast, you are navigating by looking out the rear window, and that is not a good way to be navigating. Number 2, more than 40% of your revenue comes from a single source. More than 40% of your revenue comes from a single source. That's a problem. Whether it's one major donor, one government grant, or one annual event, that level of concentration means you are flying on one engine, ladies and gentlemen, and that is not a good way to be navigating your organization. Warning light number 3. You are spending more than 10% of your time on financial tasks that are not your core strength. You are spending more than 10% of your time on financial tasks that are not your core strength. Every hour you spend building spreadsheets is an hour you are not spending on the leadership work that only you can do and that propels your organization forward. Eastern Airlines Flight 980. A mechanically sound aircraft that flew into a mountain because the crew did not have the instruments to see where they actually were. They were not bad pilots. They were flying with the wrong tools for the terrain that they were flying into. A fractional CFO is not a bookkeeper, not a backward-looking function. A fractional CFO is not a luxury only for large organizations. A fractional CFO is not a replacement for your leadership. A fractional CFO is the instrument panel that shows you where you are headed, what you need to do to land safely. They give you the data you need so that you can make more efficient decisions, better decisions, and quicker decisions. Ladies and gentlemen, if any of that resonated with you, find me on LinkedIn or visit crosswindcfo.com. Download the First 90 Days Framework for free. And if you want to have a conversation about what your organization needs, there's no sales pitch, just a conversation. I would love to have that opportunity. Book your free discovery call today. Go to crosswindcfo.com and you can book that free discovery call today. Ladies and gentlemen, thank you for joining me today on the Crosswind Approach. If today's episode gave you something to think about, here are 3 things I would ask you to do right now. 1, would you please subscribe to the Crosswind Approach so you never miss an episode? I would love that. Right now, just take a moment to subscribe to the Crosswind Approach. Number 2, leave a review for me on Apple Podcasts or Spotify. That helps me a ton. I would appreciate it if right now you would leave a review. It takes less than a minute, and it helps other mission-focused leaders find this podcast. Number 3, share this episode with a nonprofit leader in your network who's carrying a financial weight they should not have to carry alone. Ladies and gentlemen, you have reached your final destination. Thank you for choosing the Crosswind Approach. Now go lead your mission with clarity, confidence, and courage, and I look forward to seeing you on the next flight. Have a great day. Thank you for joining me on the Crosswind Approach. If today's conversation helped you think differently about leadership, financial clarity, or navigating uncertainty, I would encourage you to subscribe to the podcast and share this episode with another mission-driven leader. And if you'd like to learn more about my work as a CPA and fractional CFO supporting nonprofits and mission-focused organizations, you can connect with me on LinkedIn. You'll find the link in the show notes, and I'd love to continue the conversation there. Until next time, keep your instruments calibrated, your communication clear, and your mission moving forward.